Right. You can start now, sir. Thank you.
Okay, right. Thank you. So, so today our focus would be to complete the balance part of ISA 220 revise, and then the ISA 540, and then ISA 550 because it's a small standard. So let me see how I'm going to do that. So, but just to start with ISA 220 revise, we in fact covered uh, up to client acceptance and continuance. So just to refresh our knowledge, so ISA 220 was revised along with the revision to not actually, so in place of ISQC1, International Standard on Quality Control, which addresses firm system of quality control. ISSB issued two standard. One is ISQM1, quality management for firms that perform audit or reviews of financial statement. ISQM2, which specifically deals with engagement quality reviews, which was part of the two standard, ISA 220 and ISQC1. So they have actually the engagement quality reviewer is no longer a member of the engagement team, no longer a member of the engagement team. So it is covered under ISQM2. So uh, if you see, so this effective date in international context is effective for audit of financial statement for periods beginning on or after 15 December 2022, but in this in Sri Lanka context it's 15 December 2023. So as I explained, ISQM1 deals with the system of quality management. Under ISQC1, we call it system of quality control. So the name has got changed, but effectively it addresses system of quality management at firm level. Policies, procedures, processes at firm level. System of quality management. ISQM2, as I explained earlier, it addresses the engagement quality review process, and then ISA 220, which address the quality management at engagement level, right? So there are, under ISQC1 we had six elements. Terms were a bit different, but we had six elements. So the two items marked in blue color: firm risk assessment process and information and communication were added as part of ISQM1. Earlier, we had six elements. So, governance and leadership, relevant ethical requirements, including independence, acceptance and continuous of client relationship, engagement performance, resources, and monitoring and remediation process were part of ISQC1. ISQC1 we would do actually ISQM1 and ISQM2 we will cover under advanced audit and assurance. But for this course, the focus is on ISA 220 revise. But just to set the context only, I'm explaining how the standard got revised and the new standard ISQM 2 was introduced. So the two items, and then ISA 220, so we had six elements, so which continue to be there are six elements, but there are changes to the terms. Leadership responsibilities for managing and achieving quality on audits, because ISA 220 deals with the quality management at engagement level, while ISQM1 deals with the system of quality management at firm level. So relevant ethical requirement, including those related to independence, acceptance, continuance of client relationships and audit engagement, engagement resources, engagement performance, monitoring and remediation. So these are the basically the six elements coming under ISA 220. So as I explained, risk assessment process and information and communication were uh, added to the six components we had under ISQC1. So these are the, now actually we are getting to ISA 220, so we covered. I'm not going to go through those. Leadership responsibilities for managing and achieving the quality of audits. So the is actually the engagement partner shall take the overall responsibility. He can delegate some certain work, but the overall responsibility lies with him. So finally, he is responsible for the quality and to the in the quality, and then is responsible to the firm that the whatever the policies, procedures, and processes that have been designed as part of the firm system of quality management have been applied as required wherever applicable to achieve the quality. So then relevant ethical requirements including those related to independence. Then we discuss acceptance and continuance of client relationships and audit engagement. So there I explain there are three things there. One is accepting a new client. The other one is continuing uh, an engagement with an existing client. Third one is accepting a new engagement with an existing client. So under the firm system of quality management, there should be processes, the procedures we need to follow when we are accepting a new client, when we are making the decision whether to continue with an existing client. That means we have done the audit last year, and then you have to do the continuance assessment whether we can continue or whether we need to deselect or we need to withdraw from the engagement. Then accepting a new engagement from an existing client. Let's say we have been asked to do a now provide some other service other than the audit services. And the firm system of quality management should ensure now, if you are going to accept a new engagement from an existing client, whether it will create issues to the independence, whether there will be a conflict of interest, whether it will create uh, threat to independence, right? Then the engagement resources. Now, earlier we mainly focused on human resources, but under ISQM 1, which get finally linked to ISA 220, as I explained, ISQM 1 is at firm level, ISA 220 at engagement level. So, what is getting, at the firm level, get finally, uh, you know, uh, routed to basically the engagement level, right? So we are discussing three things. One is human resources, technological resources, and intellectual resources. Now, if you take human resources, is the engagement team members. Then technological resources, the technological tools we have. Let's say audit tools. Now, in our firm, we have our software, the audit methodology. The methodology documents are there, but then the tool we use to document our audit work. Then we have other tools like uh, different tools to analyze journal entries. Then intellectual resources, our audit methodologies, implementation tools, and then audit programs, templates, checklist, likewise. So it talks about three. So the engagement partner has to assure. Now, if you are going to ensure the what is the overall objective of the standard. So the objective of ISA 220 revise is for the auditor to manage quality at the engagement level to obtain reasonable assurance, which is a high level of assurance but not an absolute level of assurance. That quality has been achieved that's such that the auditor has fulfilled the auditor's responsibilities and has conducted the audit in accordance with professional standard. So we do audit in accordance with Sri Lanka auditing standard and applicable legal and regulatory requirements wherever applicable. If it is a banking audit, then there are other legal and regulatory requirements. If it is a telco audit, yes. Then it's an insurance audit, likewise. Then the auditor report is appropriate in the circumstances. That means we have issued an appropriate opinion. Well, we have minimized the audit risk to an acceptably low level. What is the audit risk? Audit risk is risk of issuing an inappropriate opinion. When the financial statements are materially misstated, if we issue an unmodified opinion, then it's we have not issued an appropriate report. When financial statements are not materially misstated, again you go and issue a modified opinion. So last lecture also I explained the difference between modified versus unmodified opinion. Unmodified opinion, unqualified opinion, or a clean report we issue when the financial statement provide a true and fair view. So, in other words, financial statements have been prepared in all material respect in accordance with the applicable financial reporting framework. But we deviate, there are circumstances under which we deviate from an unmodified opinion to a modified opinion. So last week also I explained under two circumstances, I'm not going to repeat those. So the two objectives are the auditor has fulfilled the auditor's responsibilities and has conducted the audit in accordance with the applicable professional standard and applicable legal and regular requirement, and the auditor's report issued is appropriate, which means uh, not inappropriate in the circumstances. This ISA is effective. I mean that's the date. Let's go to where we were. So the engagement partner has to assure that engagement team and any auditors external expert. Now, what do you mean by auditors external expert? Let's say we do insurance audit. So they have to do the actuarial valuation of life fund. We are doing, let's say, life insurance, actuarial valuation of life fund. So probably within the engagement team, we do not have that skill set. So that's a very specialized area. In that case, the auditor will deploy or get the services of a actuary. So client will have their actuaries to do uh, the valuation, but then the auditors also will get you know auditors expert to support, so that the I mean that those are called auditors expert, and internal auditors who provide direct assistance who are not part of the engagement team collectively have the appropriate competence and capabilities, including sufficient time to perform the audit engagement. So it is the responsibility of the engagement partner, as I explained, to perform the audit in accordance with the professional standard and applicable and regulatory requirements and enable an auditor to issue a report that is appropriate in the circumstances. So it is the engagement partner responsibility to ensure appropriate level of human resources with required competencies and capabilities, and technological resource and intellectual resources are made available to conduct the audit to achieve the required quality. So the same thing, there are three categories: human resources, technological, and then intellectual resources. Now, who are part of the engagement resources? The first one, the engagement team includes partners and staff performing the engagement. In, in the engagement partner own location and in another location. So partners and staff performing the engagement in the engagement partner own location in another location. Let's say in certain network firms, you have, shared services centers. So generally the work, standard work is assigned to staff in shared services. So they perform work on behalf of the engagement. So they will not be based in. Now, if you take uh, PwC has a shared service center in uh, Calcutta and then Abu Dhabi. So likewise. So what happened is basically certain piece of work, particularly the standard work, are assigned to the staff in the shared services center, and then the engagement partners own location also there will be staff who will be mainly focused on significant and other judgmental areas. So that's the way. Then other individuals who perform audit procedures on the engagement, individuals including component auditors from a network firm who are supporting the engagement. Let's say we have a subsidiary in India, the component auditors also from the same network firm. Individuals including component auditors from a firm that is not network firm or another service provider. The engagement team may also include an auditor's internal expert. Let's say if you take, today, a practicing firm will have, the audit practice and then tax practice and also the advisory and consulting. Let's say there are complex tax related matters, we would get the support from our internal tax expert. If there is a business valuation, we would get uh, support from our valuation expert who are part of our advisory and consulting practice, right? Then individuals from service delivery centers, again individuals with expertise in a specialized area of accounting auditing, the technical team. However, the engagement team does not include an individual whose involvement is limited to consultation. An auditor's external expert. So I explained earlier also. The third party. We are getting an actuary to support us to validate the process followed by the management expert. The engagement quality review and other individuals performing the engagement quality review. So before this revision or before we, the ISSB introduced the ISQM2, the engagement quality reviewer was, covered under ISA 220 and was part of the engagement team, right? But now there is a separate standard ISQM2, and the quality reviewer is not part of the engagement team, and the expectation and the responsibilities, all that are covered under ISQM2. Then internal auditors who provide direct assistance on an engagement. Now, the engagement performance, which is the the fifth one. The engagement partner shall take responsibility for the engagement team undertaking consultation on difficult or contentious matters and matters on which firm policies or procedures require consultation. So, there are difficult or contentious accounting or auditing matters. So, in that case, rather than, the under the firm system of quality management, they highlight these areas you need to go for a consultation. You need to go for a consultation. As an example, generally for a profit oriented entity, you would have covered this under materiality. Materiality, the benchmark for a profit oriented entity, materiality is computed based on results of operations. That means profit or loss. So that's basically the standard benchmark. But there are situations if the results of operation, either profit or loss, closer to the break-even level, then when you calculate material, let's say 5% or 10% of profit before tax or loss before tax, which is very closer to break-even level, you will end up with a lower materiality level. You will end up with a lower materiality level, which means the transactions and balances above that particular materiality level would be subject to audit procedures. When you calculate lower materiality level, you will appreciate that most of the transactions and balances above that level, above that lower material level, will be subject to testing, will be subject to audit procedures. So I hope you all are clear. I'm just giving an example. Let's say for a profit oriented entity, when you calculate the materiality, generally the most appropriate benchmark is profit before tax. So if the profit or the entity has a loss, which is very closer to break even, if let's say it is 1 million, if you apply 5%, the materiality level is 50,000. Materiality level is 50,000. So the transactions, balances, and disclosures above that materiality level would be subject to audit procedures. So what happens when the materiality level is very low, you end up with over auditing. Auditing is not about over auditing or under auditing, but identifying and calculating the right materiality level which reflect the risk of the engagement and then performing audit procedures. But if you calculate a very lower materiality level, Result would be you are performing more audit procedures but would end up doing over auditing. If the materiality level is very high, then probably you would be under-auditing, because above materiality level transactions balances would be subject to some form of audit procedures, control testing plus substantive procedures or purely substantive procedures. So in that sort of a situation, generally the firms use average profit or loss based on the absolute figures, right? Let's say last 3 years we had 2 years profit and then 1 year loss. We will consider the absolute value and calculate the weighted average profit and then calculate the materiality. Or in certain situation, we would consider revenue as the appropriate benchmark or total assets or net assets. In that sort of a situation, it will require consultation. I mean, that cannot be determined by the engagement team. That has to be, I mean, the engagement team has to raise a consultation and get it cleared through, let's say, as an example, from the methodology team. We, instead of profit before tax, because of these reasons, we have now selected weighted average profit, weighted average results of last 3 years, or we have considered revenue as the most appropriate benchmark and computed the materiality. And with these analyses and all these things, they will present, and that will be cleared by the methodology team. If there is a contentious accounting issue, again it will not be done within the engagement team, but they will I mean, the under firm system of quality management, it will highlight under what circumstances you need to raise a consultation, right? So the engagement partner shall take responsibility for engagement team undertaking consultation on difficult or contentious matters and matters on which the firm policies or procedures require consultation. What do you mean by firm policies or procedures? Those are the firm policies and procedures coming under the firm system of quality management, which is required under ISQM 1. Then other matters that in the engagement partner professional judgment require consultation. Sometimes it doesn't cover through the policies and procedures, but the engagement partner feel it's good to get a consultation. It's always good to get it cleared from another, independent source. So that will give the comfort. So I can remember about 2 years ago, there was a JV agreement. There was a JV agreement, and when you have a JV agreement, the that particular entity to be treated as a joint venture. So joint venture, there is a way of you account for. It's equity accounted. I mean, you have to account for the share of results and share of OCA. So that's the way you basically account for a JV or an associate. On top of the JV agreement, when you read the clauses, I mean, one party gets, de facto control. I mean, the clauses say that they can acquire other party stake, the other JV partner stake, without the consent of the other party. And that indicate that they indirectly control the entity despite having the joint venture agreement. And then the management wanted to account for this as a subsidiary. They say that okay, though we have termed this as a joint venture, these clauses demonstrate that we have the control over the entity, not the joint control. We have the control over the entity, and there are certain policies and procedures which has to be cleared by them. They have the major representation in the board likewise. So in that sort of a situation, definitely you have to go for a consultation, right? Determine that members of the engagement team have undertaken appropriate consultation during the audit engagement. So, whose responsibility is engagement partner? Both within the engagement team and between the engagement team and others at the appropriate level within or outside the firm. As an example, with the methodology team, with the technical team who provides advice on the accounting standard or the implication, based on the the accounting standard, right? Determine the nature and scope of and conclusion resulting from such consultation are agreed with the party consultant. So the engagement partner has to ensure that yes, we have done the consultation. So based on the outcome, both all parties agree to the conclusion. If not, we call it differences of opinion. So we will cover that also as we go along. Differences of opinion. Let's say engagement partner feels no, it should be accounted for as a subsidiary, but the technical team feels despite the clauses, it has to be accounted for as a joint venture. I mean, then there is a differences of opinion. So there is a process under the system of quality management. There should be policies and procedures, as I explained, when to request for consultation, how to resolve differences of opinion, right? Determine that conclusions agreed have been implemented prior to issue of the audit opinion. Now the engagement quality review. This slide is important, right? For audit engagement for which an engagement quality review is required, the engagement partner shall. Now, the engagement quality review is required for listed entity and any other entity required under laws and regulations, and any other entity the firm feels due to the as a response to the specific risk factors, engagement quality review is required. So, which is you are bringing now in essence engagement quality review. So if you take the engagement team is led by the engagement partner. Then you have the engagement manager. Then you have the audit team members. That's a basic typical structure of an engagement team. Now EQR, as I explained, is not part of the engagement team. So bringing EQR is we are actually bringing another line of defense. Another line of defense. So anything that that may get missed out at the engagement team level would get picked up at the engagement quality review. So, in addition to the engagement partner, you are bringing another line of defense through by appointing an engagement quality reviewer. Earlier, we call under ISQC one quality. We used to call quality review partner. So, for audit engagement for which an engagement quality is required, if it is a listed entity or required on another law or regulation, or based on the firm assessment of the risk profile of the entity, if the firm determine that engagement quality review is required, right? So these are the three things: audit of financial statement of listed entities. Okay, EQ and engagement quality review is required. Audit of other engagement for which an EQ is required by law or regulation. That's the second category. Then audits or other engagement for which the firm determines that EQ review is an appropriate response to address one or more qualities identified specific to that particular engagement. So, what are the three categories? Listed entities, audit to other engagement for which an EQ review is required by law or regulation. Those are required. Then third category is based on the uh, analysis of risk factors or quality risk. If firm determines that an EQ review is an appropriate response, those engagement also would require an engagement quality review, right? So let's go back to our. So for audit engagement for which an engagement quality review is required, the engagement partner shall determine that an engagement quality reviewer has been appointed. So that is important. Cooperate with the engagement quality reviewer and inform other members of the engagement team of their responsibility to do so. Discuss significant matters and significant judgment. As an example, matters relate to significant risk. So probably under ISA 315, you would have covered significant risk. Risk of material misstatement classified as significant risk based on the inherent risk, magnitude of potential misstatement, and likelihood of misstatement occurring. And then the other significant or judgmental areas. So discuss significant matters and significant judgment arising during the audit engagement, including those identified during the engagement quality review with the engagement quality review, and not to date the audit report until the completion of engagement quality review. This is very important. I mean, you cannot sign the audit report. I mean, who is signing the audit report is by the engagement partner. By the engagement partner, he cannot sign the audit report until the engagement quality review is over and matters arising from the engagement quality review are fully clear to the best satisfaction of the engagement quality reviewer for him to sign the file, and based on which only the engagement partner could sign the audit report. Until such time he or she should not issue the audit opinion, right? So I explain that third category is audit or other engagement for which the firm determines that an EQ review is an appropriate response. As an example, high risk client. Let's say there is a client who is in the insurance industry, not a listed entity, but because it's a specialized industry, the firm may consider we need to have an EQR. And there is an entity, let's say, as an example, Sri Lankan Airlines. You may consider because of the other, the going concern issues and other, the industry risk, and then they are in the process of restructuring, and as part of state-owned enterprise, the engagement, the firm would consider we need an engagement quality review, right? So, what are these risk factors? Now, this ISQ 11 requires firms conduct an EQR on audit of listed entities, audits and other engagement where an EQR is required by law or regulation, and audit or other engagement for which the firm determined that an EQR is an appropriate response to address one or more quality risks. Now, what are these quality risks? Audits which involve a high level of complexity or judgment due to significant accounting judgment with high degree of uncertainty, such as banks or oil exploration company, where specialized skills and knowledge is required to evaluate underlying subject matters such as greenhouse gas emissions. Audits where significant issues have been encountered, such as material restatement of comparatives, restatement of comparatives due to an accounting error, not due to a policy change. Audit of engagement for which unusual circumstances have been identified during the acceptance and continuous procedures, such as disagreement with previous auditors. Engagement involving reporting to be included in regulatory findings, which may contain high degree of judgment, such as listing prospectus. Let's say if there is an entity they are expecting to list in next 2 years time, probably the firm would consider, because they don't, I mean, when you have an intention to list, naturally you want to show the better results, so then only you can issue your first shares at the highest possible offer price. So then they would try to show significant growth in revenue, profitability, and better shape balance sheet likewise. Then audits and engagement for which the firm has no prior experience. So, as an example, the first year auditing. First year auditing. The use of EQR to mitigate ethical threats identified. Let's say if you had provided certain other services or certain, uh, issues, right? Appointment and eligibility of engagement quality reviewers. So these are the risk factors. So these slides are very important, right? These slides are very important. To ensure the effectiveness of an EQR, it is important that the person performing the review is appropriate. ISQM2 provide guidance on who is eligible to be appointed to this role. An engagement quality reviewer cannot be a member of the audit engagement team. So which we actually discussed. However, the engagement team does not include the engagement quality review and other individuals. Now, what do you mean by other individuals performing the engagement quality review? So since the partner, the engagement quality reviewer cannot review the entire file, or the not the entire file, specific areas. Generally, there are EQR managers to support the EQR partner. So that's why it says other individuals, referring to those who are supporting the EQR partner, right? Then engagement quality reviewer cannot be a member of the audit engagement team, so that they remain objective and independent. That's why they are not part of the engagement team. The reviewer needs to consider whether the audit team has applied appropriate professional skepticism. A 2 year cooling off period is required before the audit engagement partner can act as an engagement quality reviewer for their former client. Let's say I was the engagement partner for ABC company for the year ended 31st March 2022. That was my last year, as an example, right? My last year was and I have completed my term 31st March 2022. Now I cannot be there, so I have to have 2 year cooling off before I get into that engagement in any role. In any role. So I cannot be the EQR for 31st March 2023, 31st March 2024. Then I can start again to be the engagement quality reviewer. I mean, to start with the engagement quality reviewer role only for the year ending 31st March 2025. I hope you are clear. 2 year cooling off period mean I cannot be part of that engagement for 2 year period. So my last audit was as the engagement partner was 31st March 2022. So 2 year cooling off period would be completed by 30 uh, on completion of the audit for 31st March 2024, and then thereafter I can assume another role. The other one is reviewer must be competent and capable, and appropriate knowledge of the client industry, an appropriate knowledge of the client industry. Let's say a person who has never done banking audit cannot be the engagement quality reviewer for a bank audit. A person who has never done telco companies audit cannot be the engagement leader for a telco company. Let's say Dialog EQR. Now Dialog is a listed entity, Asiata. I mean, the engagement quality reviewer should have the experience on the telco industries audits. I mean, otherwise, I mean, he cannot bring that objective evaluation, right? The engagement quality reviewers must have the appropriate authority within the firm to allow them to challenge the audit engagement partner. The culture of the firm should be one where the views of the engagement quality reviews are treated with respect and not subject to influence or pressure from the audit engagement partner. That's why it says under responsibility not to date the audit report until completion of the audit engagement quality review in all respect. That means the EQR review has been completed, and then the matters arising from the engagement quality review are cleared to the best satisfaction of the engagement quality review before dating the audit report or before issuing the audit opinion. And the reviewer must comply with the relevant ethical requirement. The reviewer may be member of the audit firm or external to the firm. What do you mean by that? Now, if you see, I mean, generally in our firm, the engagement quality reviewers are, partners of our firm. That's the way how it works. But as per the standard, even outsider with, having the right competency and skill set, who is independent, who's having the experience of the particular industry, could be the engagement quality reviewer. Now, this is being practiced by the Auditor General Department. Generally, the Auditor General Department is the auditor for state banks, BOC, NSB, People's Bank, and generally they call for the proposals to support the Auditor General Department. Basically the Auditor General is the engagement partner. I mean, and bringing that the kind of engagement quality review. So when they are getting the experienced partners from other firms to support on the specialized industry audit, right? Like the Bank of Ceylon, then the People's Bank likewise, and then the other state-owned banks. So that's why the reviewer may be a member of the audit firm or external to the firm. It's not mandatory that the engagement quality reviewer should be staff of the firm. That is not a requirement or partner of the firm, right? So that's why it says, I explain, it is required for audit of financial statement of listed entities. Now, as an example, in your exam, if there is a case study saying that the engagement partner has advised the engagement team, so he has completed his review, and then client requires the audit report urgently, and hence to issue the audit report without fully completing the EQR. Then there is an uncompliance with the at the engagement level. The firms is policies and procedures that are applicable under firm system of quality control, which require the system of quality management is designed in line with the ISQCM1 requirement, ISQM1 requirement. So those policies and procedures are to be adhered to wherever applicable at the individual engagement level. Let's say there is a listed entity, and because the audit report to be issued urgently, and the board audit committee wants to approve, recommend the board to approve the financial statement. Audit partner, if audit partner, engagement partner decide to issue the audit report without fully completing the engagement quality review, there is a non-compliance with the policies and procedures with regard to firm system of quality management. So these are the three areas, the engagement which require engagement quality reviews. So that's what I was explaining. Now, differences of opinion. Now, earlier we discussed consultation. Now, when you consult with another person, that doesn't mean that you always agree with his point of view. Let's say now you are raising a consultation to get further comfort. No? So those are difficult or contentious accounting or auditing matters. And the engagement team will form their own conclusions. But you are going for another layer just to get it confirmed. But with this process, there could be differences of opinion. There could be differences of opinion. What it says, if differences of opinion arise within the engagement team. So I will explain. About 10 or 12 years ago, there was a uh, you know discussion that no deferred tax to be provided for companies who are on tax holiday period. No deferred tax to be provided for companies who are on tax holiday period. So argument was, in Sri Lanka, unlike in other countries, during that time we had long tax holiday period. Some actually were enjoying, let's say 10 years, 15 years. So why you need to compute deferred tax? Because those will get reversed during the most of the deferred tax, temporary differences or deductible temporary differences will get reversed during the tax holiday period. Then the firms had different opinion. So some firms, they said that no, you have to provide for depreciation, deferred tax, and some said no need. Then it actually went. Then there were differences of opinion. This is not related to at engagement level. I'm just explaining an example related to differences of opinion. Then CA Sri Lanka actually formed a UITF, Urgent Issues Task Force with representation from the members of the practicing firms and then the industry. And finally, actually, the conclusion was you have to make provision for deferred tax even during the tax holiday period, but with some adjustment. So they explain how that those adjustment. But the overall conclusion was deferred tax to be provided for all companies. So that was the conclusion. If differences of opinion arise within the engagement team or between the engagement team and the engagement quality reviewer or individuals performing activities within the firm of system quality management, including those provide consultation, the engagement team shall follow the firm policies or procedures. What do you mean by policies or procedures? Which are designed at the engagement, the firm level, firm system of quality management, firm system of quality management for dealing with and resolving such differences of opinion. then engagement partner shall take responsibility for differences of opinion being addressed and resolved in accordance with the firm policies and procedures. Now, if there, let's say, there is a differences of opinion in in relation to accounting matter between the engagement partner and the let's say engagement quality reviewer, or engagement partner and the technical partner, there could be a situation we have to go to a regional level, the technical team, to get their views also. So the firm policies and procedures will tell you. I mean, then whether you can resolve is at policies, policies and procedures, uh, to resolve the differences of opinion at the firm level. If not, where to go next level? Let's say UK ACS, Hong Kong ACS, likewise, right? ACS mean accounting consultancy service, right? So determine that conclusion reached are documented and implemented. Not to date the auditor's report until any differences of opinion are resolved. Same thing we said here also. Not to date the auditor's report until the completion of engagement quality review. Right? So these things you have to keep in mind, will be very important at the exam. The monitoring and remediation. The engagement partner shall take responsibility for obtaining an understanding of the information from the firm's monitoring and remediation process as communicated by the firm, including as applicable the information from the monitoring and remediation process of the network and across the network firm. This is, so he has to get an understanding of the firm system of quality management, and then the firm level monitoring and remediation process. Determining the relevance and effect of the audit engagement of the information referred to in paragraph A above and take appropriate action, and remaining alert throughout the audit engagement for information that may be relevant to the firm's monitoring and remediation process, and communicate such information to those responsible for the process. Now, these are the practice questions, right? Assuming your firm audits the financial statement of Retail Mart PLC, a company listed in the Colombo Stock Exchange. The audit for the year ended 31st March is in completion stage. The audit documentation revealed that the engagement manager has reviewed the documentation, and engagement partner 2 has reviewed the significant areas of audit documentation. Based, I mean, the audit partner will, engagement partner will never review the entire file, but he will review the documentation related to the significant and judgmental areas. Documentation and audit work relate to significant risk, likewise, right? Based on the audit work reviewed by the engagement partner and the and the engage, sorry, it should be engagement manager, right? Engagement, right? Engagement manager, they have concluded that no further work or review is required. Now, this should click your mind. This is a listed entity, right? Where we need engagement quality review, audit of financial statement of listed entities, audit or other engagement for which an EQ review is required by law or regulation. Audit to other engagement for which the firm determined that an EQ review is an appropriate response to address one or more quality risks. Right? Let's go to this. The EP has advised EM that the proposed audit opinion should be issued to the board audit committee without delay, and the review required by the engagement quality reviewer could be performed at a later stage. Mr. Calum Pereira is the QRP or the EQR. It should be EQR, right? Is the EQR. EQR, engagement quality reviewer for this audit. Engagement as retail mart is a listed public interest entity required to answer. As per ISA 220 revised quality management for an audit of financial statement, the engagement teams have a responsibility to implement quality control procedure at engagement level. List the element of a system of quality control that are to be complied. List the element. When you say list, don't try to explain. Now list the elements of a system of quality management. System of quality management. Sorry. System of management that are to be complied with by the engagement evaluation. This is basically the, I mean, when you say list, there are six. These six actually you have to write. Leadership responsibilities for managing and achieving the quality on the audit, relevant ethical requirement, acceptance and continuance, engagement resource, and the engagement performance, and then finally monitoring and remediation. Right? Let's go to the other. Right? That will carry about 3 marks, right? Then the question, discuss the quality control issue that would arise in line with the requirements sent out in ISA 220 quality management for an audit of financial statement due to EP and EM concluding that the engagement quality review to be performed by the engagement quality reviewer could be performed at a later. So you have to explain, being a listed entity, the as per ISA 220, or the as per the standard, uh, the audit report cannot be issued without the quality review being full completed, and then we have to explain it's the responsibility of the engagement partner likewise. Discuss the engagement partner's responsibilities as per ISA 220 revise in respect of engagement quality review for audit of engagement for which an engagement quality review is required. So basically listed entity or another entity which require EQR as per the laws and regulation. The other engagement the firm has determined that is an appropriate response due to one or more quality risk identified. So this is basically the what is the engagement partner responsibilities? This one. For audit engagement for which an engagement quality review is required, the engagement partner shall determine that engagement quality review has been appointed if it is required. If it's a listed entity, or if it is required and for that particular entity due, based on a law or regulation. Likewise, cooperate with the engagement quality review. Discuss significant matters and significant judgments. Not to date the auditor's reports until the completion of the engagement quality review. When you answer, let's say you have got in the exam only question number 2, not question number 3, you can inbuilt those 4 points also to question number 2. And that will carry about 6 marks, right? Then fourth question, EQR is required for audit of listed companies and audit and other engagement where an EQR is required by law or regulation. In addition, now what do you mean by in addition? We are talking about third one, no? This one. Third one, audit or other engagement for which the firm determined that an EQ review is an appropriate response. So let's go. Right? In addition, a firm can determine an EQR is required for some audits or other engagement as an appropriate response to the quality risk, one or more quality risk associated with such engagement. List down the examples of quality risk that would prompt a firm to consider an EQR, and in determining an EQR is required. So where is that? This. So audits which high level of complexity or judgment, audits where significant issues have been encountered, audits of or engagement for which unusual circumstances have been identified during the acceptance and continuous procedures, engagement involving reporting to be included in a regulatory filing such as prospectus. Audit and engagement for which the firm has no prior experience, the first year audit. The use of an inquiry to mitigate ethical threats identified. These are some of the possible questions. So, being this is the first year actually in Sri Lankan context, ISA 220 is, uh, I mean, the effective date for financial. I mean, just to go back, the date was for international context. Uh, See, the financial period for audits of financial period for beginning on after December 15, 2023 in Sri Lanka context. That means the financial period starting 1st January 2024. So it will be applicable for year ending 31st December 2020, starting with year end ending 31st December 2024. But international context is already in place actually. So these areas you should be very clear. And then please practice these questions. Question number 3 could, I mean, what we are covering in question number 3 could be part of the question number 2 as well. It's clearly against the firm policies and procedures that a engagement quality review is required, particularly this retail mart is a listed entity, and the audit report cannot be issued without the quality review is fully completed and matters arising from engagement quality review are fully addressed to the best satisfaction of the engagement quality reviewer. Right. So that's all basically we have for ISA 220. So let me go to, sorry. So are there any questions before I go to ISA 540 with regard to ISA 220 or any other section which I have done in the past? Actually, I sent the going concern audit conclusion summary. Did you all get that? This one actually. This part, sorry. Did you all get this document? Can somebody confirm? This I sent to Natasha. So generally, I share this after the session is over. Did you all get that? Can somebody confirm whether you all got? Okay, okay, right. So, are there any questions? I'll give 1 minute. Okay. Uh, are there any questions with regard to 220, 240, and then we discussed 250 as well. So today we will, and 570 the going concern standard. Are there any questions on 220 specifically? Oh, you are clear with what we have covered up to now. So we are going to go to ISA 550, 540, which is the estimate standard, which was again revised in 2022. Are there any questions? I'll give you a couple of seconds. But, I'm not sure, I'm not getting any response or anything, but let me go to the other one. Can you all see my screen now? Can somebody confirm? Can somebody confirm whether you all can see my screen? Uh, Sorry? Can you all see my screen?
Yes, sir.
Okay, okay. So we are going to discuss ISA 540, which is again revised, auditing, accounting estimates, and related disclosures. Right? So ISA 540 revised deals with the auditor's responsibilities related to accounting estimate. Now, when you say accounting estimate, there are fair value accounting estimates as well. As an example, accounting estimate, useful life of property, plant, and equipment, which is an accounting estimate. Provision for trade receivables, an accounting estimate. Provision for inventories. Provision for warranty claims. Then we have also got fair value accounting estimates. Let's say you have an investment in a listed entity. So if it is fair value through PNL or OCI, let's say you get the share price from the stock exchange or the market, and then you basically fair value, which is very straightforward, right? The fair value can be observed with market data. But let's say you have an investment in a non-list, privately held entity. Can you get the fair value like that? No, you have to estimate. You have to go for valuation techniques. No, level one, level two, level three, likewise. Then what you have to do is you have to basically fair value that investment, which is a fair value accounting estimate. You have to estimate the fair value, right? Specifically, it expands on how other relevant ISAs are to be applied in relation to accounting estimate. It also includes requirements and guidance on misstatement of individual accounting estimates and indicators of possible management bias. Right? Just to set the context. Now, what do you mean by accounting estimate as first place? Some finances statements items cannot be measured precisely. Some financial statement items cannot be measured precisely, but can only be estimated. And such financial statement items which require estimation are referred to as accounting estimates. Let's say if you go and buy a laptop from, let's say, Singer, you get an invoice. And then under property, plant, and equipment, you put under additions, the cost is, let's say, 350,000. Do you require to estimate? No. But not all financial statement items can be, measured precisely. Some financial statement items cannot be measured precisely but can only be estimated. Such financial statement items we call accounting estimate. As an example, let's say the entity is in business of selling electronic products. Let's say, as an example, Singer, Softlogic, Abans, Damro. Now they are selling. When they are selling, they are giving warranty periods. No, if it is original manufacturer's warranty, then it get covered and with the manufacturer. Now, certain organization going beyond the manufacturer's warranty and they are giving additional warranty also. That is to increase the revenue. Now, when you are giving warranties, I mean, you need to recognize provisions for warranty claims that may arise during the warranty period. Now, can you measure that precisely? No. You have to consider actual claims in the past, and then the improvements you have done to your production process, whether that would reduce the likelihood of warranty claims arising during the warranty period, and then to come up with the entity specific model. Is there a generally accepted model how you calculate the warranty provision? No. Then, based on your past record, based on management judgment and assumptions, and where considering various other factors, you need to estimate the warranty claims. And those are accounting estimate. So that's why we call some financial statement items cannot be measured precisely, but can only be estimated, and such financial statement items which require to be estimated are referred to as accounting estimate. Now, if you see in today's environment, we see many complex business model and new business model which we have never seen in about, let's say, 5, 15 years ago, now have emerged. Now, on top of those things, if you take, when I started my career, so we generally had the cost model and few standard allowed, fair value. As an example, LKS 16, property, plant, and equipment, we had the cost model and revaluation model. Then the investment property, again the cost and the fair value model. But if you take last 15 to 20 years, we have seemingly moved away from the cost model to fair value model. Now, most of the standard allow fair values and some are mandatory. As an example, now you have share option scheme. In those days, we never had share option schemes. That is the way of remunerating employees. Now, under SLFRS 2, share based payment, you need to fair value the share option at the grant date and recognize that over the vesting period. Over the vesting period. I mean, then you have to estimate the fair value, right? So we have seemingly moved away from the cost model to fair value. In the process of estimating accounting estimates of fair value, What we are trying to do here, when you are estimating the accounting estimate or fair value accounting estimate, we simply attempt to look into the future. We simply we are simply trying to look into the future based on the information available at the reporting date. When it comes to accounting estimate or fair value accounting estimate, we are simply try to look into the future based on the informations we have with us today. As an example, as at 31st March 2024, we need to estimate the warranty claim. Can you wait until the warranty period is over? No, you cannot. You need to estimate the, let's say, for a bank, they have to estimate the loan loss provision based on the ECL computation. Can you wait until the business is over? No, you cannot. So based on the information we have, based on management judgment, assumption, supported by data, assumptions, and a method, they estimate that. So, but not all accounting estimate will carry a higher inherent risk. So that you need to understand. As we go along, we will discuss. So because of this, management, the inherent risk factors, management judgment, assumptions, and complex model, entity specific models. Now, for you to estimate the warranty claim, there is no generally accepted model. It will be an entity specific model. Let's say you do a value in use calculation, under LK 16, recoverable amount is the higher of value in use and fair value less cost to dispose, which is significant estimate. And you are basically trying to estimate, let's say, value in use. You need to forecast, let's say, next 3 to 5 years, the revenue, cost, and all the other thing, and then you have to discount the cash flows to arrive at the value in use and to compare that with the carrying value, which requires significant management judgment, assumption, and use of a entity specific model. Entity specific model. So, as I explained earlier, just because of accounting estimate requires to measure as opposed to measuring the by precisely the value, that doesn't mean that each accounting estimate carry a higher risk. So that is basically the context to this standard. So you will appreciate that some financial statement items cannot be measured precisely but can only be estimated. Such financial statement items we call accounting estimate, and within that we have fair value accounting estimate as well. When you estimate, you need to have three things. As we go along, we will discuss. You need to have a method or model. How you estimate that? There should be a method or model. Then you have to have assumptions and then data. Now, let's say the last month accrual for electricity, water is again an accounting estimate. Is again an accounting estimate. Let's say by 31st March 2024, you will not get your electricity bill. No, you will not get your water bill, right? So what you do is by reference to last month bill and then this month development, you estimate that input. Those are straightforward. That's why I said not all accounting estimate will carry a higher inherent risk, right? So when it comes to accounting estimate, you have to have a method or model, assumptions and data, and we call it MAT, method or model, assumption, and then data, right? So as I explained, this standard was revised. I mean, this is the project time, sequence. So effective for period beginning on or after December 15, 2019. So that means we applied this standard first for the audit of financial statement for the year ended 31st December 2020. And we have been with this standard for, let's say, last 3 to 4 years. So what we discussed, nature of accounting estimate. Some financial statement items cannot be measured precisely, but can only be estimated. And such financial statement items we call accounting estimate or fair value accounting estimate. Accounting estimate vary widely in nature and are required to be made by management when the monetary amounts cannot be directly observed. The measurement of these monetary amount is subject to estimation uncertainty. Whenever, that's why there is always inherent risk. For some accounting estimate, inherent risk could be very high. Inherent risk arise from inherent risk factors. Inherent risk factors. What are the inherent risk factors? So we will discuss. So I'll just explain: estimation uncertainty, complexity, subjectivity, management bias. Depending on that, your assessment, you would decide whether the particular accounting estimate having a higher level of inherent risk or lower level of inherent risk, right? So that's what it says. The measurement of these monetary amounts subject to estimation uncertainty, because always it is there, no? You estimate and you can never get to the actual value. You can never get to the actual value, which reflect inherent limitation in knowledge or data. These limitations give rise to inherent subjectivity and variation in the measurement outcome. The process of making accounting estimates involves an applying a method. I explained method. So you have to have a method or model, right? When you estimate the value in use, you will use a entity specific model. But if you have a share option, generally the generally accepted model is used. The question is whether you have entity specific model or generally accepted model. For share based payment, generally accepted model is the Black Schoolers model. Now, defined benefit obligation or the gratuity actuarial valuation standard specify projected unit credit method. But VIU, value in use, the standard never specify which model. This is the model you have to have. These are the fields you have now. It almost, you use an entity specific model, but you see most of the time a common model is used. So you have to, when you are determining an accounting estimate, first you have to have method or model, and then you have to use assumption. Now let's say value in use, your revenue growth rate, discount rate, cost escalation, what is the terminal value. So generally you calculate for 3 to 5 years, and then thereafter you calculate the terminal value. What is the long term growth rate, whether it's 2% or 3%, likewise. Let's say you calculate the value in use for a telco industry company. So what is the increase in subscriber base? What is the capex? All that you will consider. What is the discount rate, right? Then the assumptions and data, which requires judgment by management and can give rise to complexity in measurement. So whenever there's something has to be estimated, it involves management judgment, management assumptions, all that. And depending on their motive, they would change the assumption. Let's say now when we have to do the impairment assessment of assets under non-current assets under IAS 36, when now let's say if you take PP, we depreciate, no? As per LK 16, property, plant, and equipment are depreciated, except for land. So land has an indefinite lifetime. But if there are impairment indicators, as per LK's 36, you have got to perform an impairment assessment when there are impairment indicators. Assets that are subject to depreciation or amortization. Then there are impairment indicators. So what you do is you consider an impairment loss if the recoverable amount is lower than the carrying value. Let's say recoverable amount 100 million, but the carrying value is 120 million. So you have to recognize an impairment loss of 20 million. What is recoverable amount? Higher of value in use and fair value less cost to dispose. Now let's say if the management, now you have to estimate value in use, right? Or the fair value less cost to dispose. Objective is to get to the recoverable amount. If management doesn't want to recognize any impairment losses, and they will come up with an impairment assessment which require higher growth rate, and that's why which require judgment and assumption by management and can give rise to complexity in measurement and possibility for management bias. The effect of complexity, these are the inherent risk factors: complexity, subjectivity, and other inherent risk factors, right? So, what are the inherent risk factors? Estimation uncertainty, complexity, subjectivity, and other inherent risk factors which involve basically the management bias and change. On the measurement of these monetary amounts affect their susceptibility to misstatement. So, certain accounting estimate, because of our assessment of inherent factors, we would end up with a higher inherent risk, whereas for some other accounting estimate, we would end up with a lower inherent risk. Not that all accounting estimate will result in a higher inherent risk, right? As an example, useful life of depreciation. And generally, we know what are the generally accepted useful life. Useful life of depreciation is an accounting estimate, and based on which you compute the depreciation. Let's say we know building generally 40 to 50 years, computer 3 years, motor vehicle 5 years, plant and machinery between 8 to 12 years, likewise, right? If somebody has used for building 100 years, then we know it is not reasonable. And those areas we don't get a higher inherent risk. Let's say, as an example, apparel sector, in the fabric or the apparel, garments. Generally, the provisioning policy is over 190 days, over 120 days or 90 days. Because you cannot keep fabric or garments beyond that because it get discolor and all that. If somebody is saying company, our inventory policy for our fabric and garments is over 365 days, auditor will easily pick up which is not in line with the acceptable no. Right, if you take a footwear company, generally the footwear company generally they may start making provisions after 120 days or 150 days or 180 days, because when the footwear is there without being sold, I mean it get cracked and all that. Similar situation with tires also, there is a period, and if they are unable to sell, so it will affect all the steel band get damaged and all that. So that's the way, right? So that's why certain accounting estimate will not result in higher inherent risk, because how do you estimate the assess the inherent risk? By analyzing the inherent risk factors. What are the inherent risk factors? Estimation uncertainty, complexity, subjectivity, or other inherent risk factors. As we go on, we'll discuss. The nature, timing, and extent of risk assessment and further procedures required will vary in relation to estimation uncertainty. And the assessment of related risk of material misstatement for accounting estimate differently, because degree to which accounting estimate is subject to estimation uncertainty will vary substantially from one to another. Not each an accounting estimate will end up with a higher level of estimation uncertainty, right? When estimation uncertainty, complexity, or subjectivity are very high, such procedures would be expected to be much more extensive, and vice versa. That means if we assess estimation uncertainty, complexity, and subjectivity at very high level, then you have to perform your risk assessment procedures to identify the risk of material misstatement at a more granular level. So, what is the risk-based audit approach? You perform risk assessment procedures and identify risk of material misstatement at financial statement level and at assertion level for classes of transaction, account balances and disclosures, and then design audit procedures which are responsive to the assessed risk of material misstatement. If, as far as the accounting estimates or fairly accounting estimates are concerned, if you assess the inherent risk is very high, which means estimation uncertainty, complexity, and subjectivity at high level, then you have got to perform extensive risk assessment procedures and related activities in order to identify the risk of material misstatement associated with such accounting estimate or fair value accounting estimate. It is required a separate assessment of inherent risk for purpose of assessing the risk of material misstatement at the assertion level for accounting estimate. Inherent risk is higher for some assertions and related classes of transaction, account balances, and disclosure. That's why. According to the assessment of inherent risk depend on the degree to which inherent risk factors affect the likelihood or magnitude of misstatement and varies on a scale that is referred to as a spectrum of inherent risk. Spectrum of inherent risk, right? So this is basically, so you first identify the inherent risk. I hope as part of ISA 315 you have at high level identified the process you need to follow to determine whether any of the risk of material misstatement identified constitute a significant risk. So basically you have to identify the risk, inherent risk, and based on your assessment of inherent risk you have to consider two things. One is magnitude of potential misstatement should the misstatement occur. Should a misstatement occur. Other one, likelihood for a material misstatement to occur. First, you assess the inherent risk. And then, that's what it says. According to the assessment of inherent risk, depend on the degree to which the inherent risk factors affect likelihood of magnitude of misstatement. Likelihood or magnitude of misstatement. The degree to which inherent risk factors affect the likelihood. Now, let's say here, magnitude of this star, magnitude of potential misstatement is very high and likelihood also very high. Now here likelihood is very high but magnitude, even misstatement occur, magnitude is very low. Now here likelihood is very low but if a misstatement occur, the magnitude of potential misstatement is so material. Now if you take this one star, likelihood is low and the magnitude is also low. Now based on how you plot magnitude and likelihood, degree to which the inherent risk factors affect the likelihood or magnitude. What are the inherent risk factors? Estimation, uncertainty, complexity, or subjectivity. Based on that, what is the level of likelihood? Whether it is less likely or more likely. Magnitude is whether it's material or immaterial. So, likewise, based on this, you will identify the accounting estimate with higher inherent risk and accounting estimate with lower inherent risk, that is based on the audit team judgment. So if you consider, so based on the spectrum of inherent risk is lower, like this, somewhere here inherent risk is very low. Now here inherent risk is very high, surely, because likelihood is very high, magnitude of potential misstatement should a misstatement occur, it is also very high. Here, other way around, likelihood is very less likelihood, and the potential misstatement is going to be immaterial, going to be immaterial. So, in that case, if the inherent risk is lower, less extensive risk assessment and further audit procedures. Now, what do you mean by risk assessment? I explained under risk based audit approach. You perform risk assessment procedures and related activities and identify risk of material misstatement and perform audit procedures which are responsive to the assessed risk of material misstatement in order to obtain sufficient appropriate audit evidence. Sufficient refers to the quantity while appropriateness refers to the relevance and reliability, right? If it is assessed at higher level, then more extensive risk assessment and further audit procedure. That's what it says. When estimation uncertainty, complexity or subjectivity are very high, such procedures to be expected to be much more extensive, right? So I will give a classic example, right? Now let me go to this annual report, right? So I actually downloaded. Sorry. Now we see this is an annual report 2019. Now see, we'll go to the balance sheet, right? Sorry, we'll go to the balance sheet. Now this is a consolidated financial statement. What is the entity? I'll show you. Because I want to explain you, right? Now see, this is a consolidate. You have a goodwill of 57 million. What is the total asset base? 9 million. 50, so you have 57,000. This is your dollar, right? This is dollar. So this is LKR, right? 57 million thousands, no. And total asset base is 9 billion. 9 billion, right? Now goodwill arising on business combination. Goodwill arising on business combinations. Now what is their profit? Let's say profit for the year is 1.8 billion. Now, what is the accounting treatment for goodwill arising on business combinations? Now, under business combinations, either you end up with the gain on bargain purchase. Now, what is the accounting treatment for gain on bargain purchase? You immediately recognize as a credit in the consolidated income statement. Goodwill, that means the purchase consideration is higher than the net assets fair value of assets and liabilities acquired. So you have end up with a positive goodwill, or we call goodwill. You have to recognize that as an asset in the balance sheet date, and at each reporting date, as per LKS 16, as per LKS 36, you have got to perform an impairment assessment, not to increase the value, but to see whether value of goodwill has suffered an impairment. That's accounting treatment. So you don't amortize the goodwill. When I started my career, so we consider the gain on bargain purchase as negative goodwill. We amortize over a period of 3 to 5 years. Positive goodwill is also same way amortized. So we never had this, fair value accounting like that complexity during that time. Now, of course, gain on bargain purchase you recognize as a credit in the income statement in that particular year, and the positive goodwill you recognize as an asset which will sit in the balance sheet as an asset, and then you have got to perform an impairment assessment as per LKS 36 to see whether the goodwill has suffered an impairment, not to increase the value. Let's say now this is, you have to estimate, no, this, you have to calculate the business value to see whether this, the goodwill has suffered an impairment. Now again, this is an accounting estimate. Now let's say from our assessment, now this is not material from total assets, profit before tax, right? Not even 5% of profit before tax. Total assets is ineligible. And then if you take the net assets, is again clearly immaterial. Now if you go back to our slide, where do you think that will get plotted in the spectrum of inherent risk based on this? Now, likelihood, unlikely. Let's say magnitude of potential misstatement. The maximum amount that you need to impair is 57 million. 57 million, which is not material, against results, against total assets, against net assets. By all means, it's not material. So probably that sort of a thing would end up with somewhere here, somewhere here. So which means our assessment of inherent risk of the impairment assessment of goodwill, inherent risk we will term as lower, because generally the always there is estimation as a complexity and subjectivity, but When you consider with the other two magnitude of potential misstatement, that's what it says. The assessment of inherent risk depends on the degree to which the inherent risk factors affects likelihood or magnitude of misstatement. Even if there is a misstatement, you are not getting, anything. So that's why if the inherent risk is, classified or assessed as lower, less extensive risk assessment and further audit procedures, and if it is higher, more extensive risk assessment and further audit procedures. I'm just spending, more time on the initial so that you understand the concept. Auditor is required to evaluate based on the audit procedures performed and the audit evidence obtained. First, you perform the risk assessment procedures, and then you identify the risk of material misstatement associated with accounting estimate, and then you perform further audit procedures in order to obtain sufficient appropriate audit evidence, which is basically the risk-based audit approach, right? Whether the accounting estimates and related disclosures are reasonable in line with the requirement of the applicable financial reporting framework, including the recognition criteria, measurement basis, and related presentation and disclosure requirement, which inter alia include the method, assumptions, and data selection of management point estimate. What do you mean by management point estimate? It is the amount decided by the management to be included in the books of account. Point estimate, the amount of warranty provision, 150 million, let's say, warranty provision, that is management point estimate. Provision for inventory, 120 million, management, that is management point estimate. Value in use, let's say carrying value is 150 million, value in use 175 million, that is management estimate, right? Then fair value of share options, that is management point estimate of the fair value. The disclosures about the accounting estimate, including disclosures about how the accounting estimate was developed, and that explain the nature, extent, and sources of estimation uncertainty. Basically, it discuss about the method, assumptions, and data. The auditor shall review the outcome of previous accounting estimate, or where applicable, their subsequent re-estimation to assist in identifying and assessing the risk of material misstatement in the current period. Let's say they have made the provision for warranty claims last year 100 million. We would always assess based on the actual results whether it was 100 million or 200 million or 10 million. That is to support in identifying and assessing the risk of material misstatement by reference, by assessing the specific inherent risk factors. Now, this is very important. I explain in when it comes to accounting estimate, you try to look into the future based on the information available. Basically, based on the best available information, you estimate at the reporting date. So, a difference between the outcome of an accounting estimate, the amount originally recognized or disclosed in the financial statement, does not necessarily represent a mistake. Let's say they have made a provision for warranty claims, let's say the customer claims 100 million, but actual one has become 150 million. That doesn't necessarily represent a misstatement. That depends on our assessment of inherent risk factors, estimation uncertainty, subjectivity and complexity, and possibility for management bias. Then only you can decide. Just because of you have a difference between what was provided, what was estimated, and the actual outcome doesn't mean that you have an estimate, because you, when it comes to accounting estimate, you look into the future based on the best available information at the reporting date. So there will be always changes since then, and that would result in a totally different figure than the amount estimated at the reporting date. That's why it says a difference between the outcome of an accounting estimate and the amount originally recognized or disclosed in the financial statement does not necessarily represent a misstatement of the financial statement, on the basis that previously accounting estimates were made based on the information available at that time. Accounting estimates share one characteristic above all others, that they attempt to look into the future and consequently could be subject to higher or lower degree of estimation uncertainty that will drive the inherent risk when you combine with the other inherent risk factors, right? So auditor's objective. So just to go back to your presentation, wait, sorry, sorry. So just to confirm, are you all clear that I set the context? Uh, just let me know whether you are clear with this accounting estimate. So you have to carry a few things. One is the inherent risk factors, and then the in the, the spectrum of inherent risk. And one very important thing: not each and every accounting estimate carry a higher inherent risk. I will, that is very important for you to understand. When we discuss the potential questions, you will notice that, right? So we are going back to this one, right? So the objective of the auditor is to obtain sufficient appropriate audit evidence about whether the accounting estimate and related disclosures in the financial statements are reasonable, not to ensure that those are accurate. We are not giving an opinion on the financial statement that financial statements are accurate. Reasonable in the context of the applicable financial reporting framework. Some definitions. Accounting estimate, a monetary amount for which the measurement in accordance with the requirement of the applicable financial reporting framework is subject to estimation uncertainty. That's an accounting estimate. Always accounting estimate will have estimation uncertainty. For some, it will be very minimal or uh, not material. For some, it could be material. Auditor's point estimate to auditor's range. I explained earlier, management point estimate. That is the amount that would appear, amount or disclosure that would appear in the financial statement. That would appear in the financial statement. Now, when it comes to accounting estimate, if the auditors also would can develop point estimate. So when we discuss approach to responding to risk of material misstatement associated with the accounting estimate, we will discuss. Auditors also can develop a point estimate. Let's say management basically has basically calculate the fair value of share option scheme. The auditors also could use a point estimate to calculate the fair value of share option scheme justifiable. Auditors could also compute their own calculation, right? So it could be either auditor's point estimate. Let's say management value is 100 million, management point estimate. Auditor would say, based on my assessment, it should be 120 million. Or auditors would say, based on my assessment, so let's say once again, right? Management point estimate is 100 million. Auditor can develop his or her own point estimate. Let's say it's 120 million. So management 100, auditors 120. So there is a difference of 20 million. Depending on the materiality of that, the auditors will request management to do the corrections or just to revisit their accounting estimate. Or auditors can come up with the range also. Based on my assessment, it should be in the range of 80 to 110. In that case, management point estimate, which is 100 million, is within the range. In that case, auditor can conclude that management point estimate is reasonable, because auditor has calculated a range is between, it should be somewhere around 80 million to 110 million. Management point estimate is 100 million, so they are basically, that is base management point estimate is within the range of the auditors. But if the auditor's range is, auditor would say the provision for warranty claims should be, in my opinion, in between 130 to 160, Management point estimate 100 mean clearly there is a management point estimate outside the range of the auditors. Then it has to be assessed based on the materiality level, right? So when it comes to accounting estimate, by looking at their model assumptions and data, you could always say something is not right, but it is very difficult for you to tell what is right. As an example, if you do a business valuation for telco company, they have said we are expecting 25% growth in our subscriber base. I explained in previous lectures also. In Sri Lanka, mobile penetration is higher than our population. If somebody estimate we will have an increase of 25% in our subscriber base, you have to eat into others market share, which is very difficult. And generally you don't change your phone because you don't want to change your number, because everybody, you have given that number to everyone. So that's generally tendency. But if the auditor say 25% is unlikely, which is way above, if management asks or somebody asks from the auditor, okay, what is the percentage we should use? I mean, auditor is also unable to state. That's why when it comes to accounting estimate, it's for you. It's easy to say that something is not right, but it's very difficult for you to say what is right also, right? Then estimation uncertainty, the susceptibility to an inherent lack of precision, it's in measurement. Management bias, a lack of neutrality by management in the preparation of information. So we have the detailed explanation for this. Management point estimate we already discussed. Outcome of an accounting estimate, the actual monetary amount which results from the resolution of the underlying transaction, events or conditions addressed by the accounting estimate. Let's say you have got a customer claim due to the products manufactured are not in line with the customer specification or late delivery. So you have estimated it will be 100 million. When it come, actually it has become 150 million. So that is an outcome of the accounting estimate. So I explained, having a difference between what was originally estimated and the actual outcome does not necessarily represent an misstatement, because when it comes to accounting estimate, you try to look into the future based on the best available information at the time of estimating the amount for the accounting estimate, right? So, inherent risk factors are characteristic of conditions and events that may affect the susceptibility of an assertion to a misstatement before consideration of inherent risk factors. When I mean, to degree to which they affect the likelihood and magnitude of potential misstatement affect the finally uh, the inherent risk assessment. If it is low, we said in the spectrum of inherent risk, if it is low, less extensive risk assessment procedures and further audit procedures, and vice versa, right? The ISA 450, 540 focuses on the inherent risk factors. There are three: estimation uncertainty, complexity and subjectivity, and then there could be other inherent risk factors that the auditor is required to take into account, like change in the financial reporting framework or circumstance. As an example, earlier the operating leases were off balance sheet items. Now, of course, under the IFRS 16, you have to recognize the basically the future payments, lease payments, the present value of future lease payment as lease liabilities, present value, and then the corresponding value to be recognized as right of use asset. Then susceptibility to a misstatement due to management bias or fraud. If they don't want to recognize an impairment loss, they would probably twist their assumptions and all these to not to have an impairment loss if they when they do a value in use calculation. Now the complexity is inherent. Is the complexity inherent in the process of making an accounting estimate? Such, what is the process of making an accounting estimate? Method, assumptions, and data. Such as when multiple data sets or assumptions are required or when complex models are used. As an example, estimating the loan loss provision in a bank, you use a complex model, multiple data sets, because you have different loan portfolio and different risk factors. Likewise, complexity is there. Then subjectivity arises from inherent limitation in the knowledge or data reasonably available about the valuation aptitude. The estimation uncertainty is the susceptibility to an inherent lack of precision in the measurement of an accounting estimate. Estimation uncertainty influences the other inherent risk factors. The degree of estimation uncertainty varies based on the nature of accounting estimate, the extent to which there is a generally accepted method or model, like value in use, or even the ECL calculation would be based on a entity specific model. But if you consider the share based payments, the share option fair value, generally the model uses the Black Schoolers model. For gratuity, standard specified projected unit credit method. So that is generally accepted. But if the model is entity specific, then the estimation uncertainty could be high, right? And the subjective the assumption used to make the accounting estimate. Management bias. Financial reporting frameworks often call for neutrality, that is, freedom from bias. Accounting estimates are imprecise. Why? They are not precise. Why? They have to be estimated. Then they can never be precise. However, and can be influenced by management judgment. Such judgment may involve unintentional or intentional management bias. For example, as a result of motivation to achieve a desired result, let's say their already profit is 100 million, which is the target on which they get the incentive, and they don't want to recognize any provisions, any further provisions. Then it's actually they would change, then there could be a possibility for management bias. The susceptibility of an accounting estimate to management bias increase with the subjective involved in making it. Unintentional management bias and the potential for intentional management bias are inherent in subjective decision that are often required in making an accounting estimate. For continuing audits, indicators of possible management bias identified during the audit of the preceding period influence the planning and risk identification and assessment activities of the auditor in the current period. So, estimation uncertainty of accounting estimate and fair value accounting estimate. So, this actually we have already covered. The estimation answer depends on these factors: nature of the accounting estimate, reliability of the information used, whether generally accepted model or method available, subjectivity of the assumption used to make the estimation, possibility for management judgment and assumption. When there is subjectivity, yes, there could be possibility for management bias. So high degree of estimation uncertainty and susceptibility for management bias. Now higher level of inherent risk, estimate of outcome of a litigation. Let's say there is a litigation against the company, and there is a strong likelihood that we are going to lose, and you have to estimate. And if it meet the provision recognition criteria, all three criteria in LK's 36 30 37, right? 37, that means as a result of past event there is a present obligation as a result of past event, and you need resource to settle, and the reliable estimate of the provision can be made. If all three criteria are met, only you recognize a provision as per LK's 37, right? So now this sort of the estimate of an outcome of a litigation, impairment of goodwill arising from business combination, which I explained earlier also, estimating warranty claims, value in use of PP. These accounting estimate or fair value accounting estimate will result in higher level of inherent risk, which mean what? They would lie in the spectrum of inherent risk at the higher end, which means we have to the auditor has to do more basically extensive risk assessment procedures and further audit procedures, right? Then useful life of PP, estimate of quoted price of shares, estimate of inventory obsolescence. Generally, these are very straightforward, and we know generally what what is being used by the other companies in the same industry, right? So this is same thing. I'm not going to go. These are finance. Now, risk-based audit approach. What are the approach? Risk assessment procedures and related activities, and response to assess risk of material misstatement. And then further substantive procedures respond to significant risk. Some of the risk of material misstatement related to accounting estimate we would consider as a significant risk. Depending on our assessment of inherent risk and degree to which the inherent risk factors are affected by the magnitude of potential misstatement and likelihood of misstatement occurring. Then evaluate the reasonableness of the accounting estimate in the context of the applicable financial reporting framework. Now, the first one, understanding the entity and its environment, including internal control related to AI. Now, under ISA 315, you would have discussed we need to understand the entity and its environment, including internal controls. What are the components of internal controls? Control environment, risk assessment, control activities, information and communication, and monitoring of controls. And there are, certain things to be understood under entity and its environment, right? Then degree of estimation uncertainty and inherent risk factors associated with each accounting estimate, and then whether any of the inherent risk factors would result in a significant risk. Now that generally the here somewhere here magnitude of potential misstatement is very high. At the same time, likelihood of misstatement occurring is also very high. Generally, those will get, we will assess having higher level of inherent risk and would, finally end up as significant risk, right? Then responses to assess risk of material misstatement. Appropriate. The first one is whether the applicable financial reporting framework has been appropriately applied in terms of recognition, in terms of measurement, in terms of presentation, in terms of disclosure. Methods are appropriate and applied consistently. The method or the model used are consistently applied. Any changes are appropriate. And then the assumption use are appropriate and reasonable, and the data use are reasonable. So there are three approaches. When we go to that, we will discuss. Then further substantive procedures to respond significant risk associated with accounting estimate. Estimation uncertainty, you have to basically work on the alternative assumption, basically which means you mean basically you have to uh, generally you the auditor's point estimate to auditor's range. Significant assumptions likewise, right? So let's go to this, right? Risk-based approach to accounting estimate. So you know what is risk-based audit approach. Obtaining an understanding of the entity and its environment through risk assessment procedures, including internal controls. Based on that understanding, so we have to understand degree of estimation uncertainty and inherent risk factors. Based on our understanding of the entity and its environment, including internal controls related to accounting estimate, you need to identify the inherent risk. Based on that understanding, identifying and assessing the risk of material misstatement associated with accounting estimate. Then, what is the risk-based audit approach? Perform further audit procedures which are responsive to the assessed risk of material misstatement related to accounting estimate. So that's what it says. Obtaining sufficient appropriate audit evidence regarding the assessed risk of material risk through designing and implementing appropriate response to those risks. So these things, I mean, you can go through. I'm not going to go through, right? Now this is responded to assess risk. First, whether the accounting estimate meet the requirement of applicable financial reporting framework, and then method of making accounting estimates appropriate, that means method or model, applied consistently from previous years, any changes are appropriate, and then data and assumptions are reasonable. Now there are three approaches in responding to the assess risk of material misstatement related to accounting estimate. The auditor shall undertake one or more of the following, taking account of the nature of the accounting estimate. Audit procedures whose nature, timing, and extent are to be responsive to the assessed risk of material misstatement in relation to the accounting estimate at both financial statement and assessment level. There are three testing approaches an auditor could use. One is first one. This slide is important, right? Obtaining audit evidence from events occurring up to the date of auditor's report, provide audit evidence regarding the accounting estimate. As an example, management has provided for bonus, and generally after the year end they make the payment. So by the time you finish the audit, they have made the payment for bonus, and then you can calculate easily over or under provision. Simple. Let's say another one, they have made provision for electricity, water bill, and all these other service providers. And then subsequent year end, generally we undertake an unrecorded liability test as well. You get the actual bills and then compare with what has been provided, because that is an accounting estimate. Depending on the materiality of over or under provision, the auditor would basically suggest for any adjustment. So that's the first approach. What is the first approach of responding to assess risk of material misstatement related to accounting estimate? Obtaining audit evidence from events occurring up to the date of the auditor's report, provide audit evidence regarding the accounting estimate. Then second approach, if that is not, let's say, warranty provision, I mean that will not get cleared before the audit is over, no, right? Then value in use calculation, which actually estimate the financial forecast for next 3 to 5 years and calculate. In that thing, the second approach is testing how management made the accounting estimate, method, assumptions, and data they use, right? It talks about the method, assumptions, and data. That's what it says. And the data and assumption on which it is based. In doing so, the auditor shall evaluate whether the method of measurement used is appropriate in the circumstances, whether that has been consistently applied. The data and assumption used by the management are reasonable in light of the measurement objective of the applicable financial reporting framework. If auditor is satisfied, then test the operating effectiveness of the control over how management made the accounting estimate, together with the appropriate substantive. Basically, who is preparing, who is approving this, who is providing base data, how do they ensure the base data used for the accounting estimate, to develop the accounting estimate using the method or the model, data, and assumptions is appropriate. And then perform substantive procedures, right? So basically, you are here, what you are doing is you are assessing you are performing audit procedures on the management point estimate. Management point estimate. What is the method they have used? Data and the assumptions they have used, right? So basically, that's what the auditor is performing. Testing the management point estimate. If that is not, if you are not comfortable with the method or data or assumptions, auditor has different view. The third approach is developing a auditor's point estimate or a range to evaluate management point estimate for this purpose. If the auditor use data, assumptions, or method that differ from the management, I mean, that's why you are developing your own point estimate or a range. If you are comfortable with management method, data, and assumption use, and based on the assessment of the reasonability and performing the controls over that management process over developing the accounting estimate, then you would stop at that point. No further audit evidence is required. If it is not the case, the auditor would develop his or her own point estimate or range to evaluate to compare with the management point estimate. If the auditor uses data, assumptions, or method that differ from management, The auditor shall obtain an understanding of the management assumptions or methods sufficient to establish that the auditor's point estimate or range takes into account relevant variables and to evaluate any significant differences from management point estimate. If the auditor concludes that it is appropriate to use a range, the auditor shall narrow the range based on the audit evidence available, either from auditor's point estimate or range. If the management points estimate falls within the auditor's range, then it is okay. If it is outside the range, either below the lower end or above the upper end, then it would constitute a misstatement. If auditor's point estimate is or the point estimate differ from the management point estimate, it is a misstatement. But depending on the materiality, you would assess whether the auditor or the management is required to make adjustment in the books of account, or if not, whether the auditor should modify the audit opinion, right? So these things, just you looked at the method, assumptions, and data. So these there are some questions I will show you when it comes, right? So this is actually in essence the misstatement. The auditor shall evaluate based on the audit evidence whether the accounting estimate in the financial statement are either reasonable in the context of the applicable financial reporting framework or misstated. The misstatement could result. See, management point estimate. This is what appearing in the financial statement. Auditor's point estimate or auditor's range of estimates supported with audit evidence. One is if auditor's point estimate is different to management point estimate, it would result in, that means not equal, then it's a misstatement. The other is when there is a range. If the auditor's range is I mean the for management point estimate outside the auditor's range, again that would result in a misstatement. Then changes of accounting estimate or method of making the accounting estimate is considered arbitrary, then again it will result in a misstatement. So there are three types of misstatement. One is factual misstatement, other one is projected misstatement, third one is judgmental misstatement. Generally, judgmental misstatements are associated with accounting estimate, because when it comes to accounting estimates, it's very difficult for either party to factually state the misstatement is based on the method, assumptions, and data. Management would, based on best available information, management would estimate the accounting estimate, and then auditors also would follow if they take the third approach. What is the third approach? Developing a point estimate or range. In that case, the misstatement, there are three types of misstatement. Did you all do ISA 450 standard? ISA 450 standard? Can somebody confirm that to me? Did you all do ISA 450 as part of this course? In that, basically, we discuss there are three types of misstatement: factual, other one is projected, other one is judgmental. Judgmental misstatement generally associate with accounting estimate, because accounting estimate cannot be measured precisely but can only be estimated, right? Did you all do ISA 450 as part of this course? Can somebody send, just confirm that to me in a chat message? So basically ISA 450, right? This is evaluation of misstatement identified. I'm not going to explain this, but I mean, you can go through, but will not have a major bearing on the exam. So that's what I'm not going to do that. So let me see if somebody has confirmed. So nobody has confirmed. I don't know whether that was done or not. So these are the so this now these are examples of accounting estimate. Now you see share-based payments. I explained that generally accepted model that is used. What is the accounting standard? SLFRS2. The fair value of share option scheme to be Options to be estimated as at the grant date and to be recognized over the vesting period. That's a requirement, right? So generally accepted model that is used is Black Schoolers model. I will show you. Now this is generally Black Schoolers model is commonly used for valuation of share options. Option value, intrinsic value, time value. These are the certain assumptions used. Just I will show you if I go to uh, this account set. There is actually share options. This see the fair value of the account. The fair value at the grant date is independently determined using the Black Schoolers model, and they have given certain things that has been considered: the exercise price, term of the option, the impact of the dilution. So likewise, right? See, the exercise price of the option, the life of the option, the current price of the underlying shares. This is the generally accepted model. In this sort of a situation, inherent risk would be assessed as not high, probably low to moderate. When it comes to share based payment, the inherent risk based on your evaluation of inherent risk factors, estimation uncertainty, subjectivity, uh, uh, all these complexity and the other inherent. Now if you say now here the exercise price of the option which is given in the share option scheme, the price at which the employees can buy the shares at the end of the vesting period, right? The life of the option which is the vesting period, that is clearly given. The current price of the underlying shares you can easily get from the share market. The expected volatility of the share price, I mean, you can get the last 90 days to 120 days and calculate the dividend expected on the shares, the risk free interest rate. And if you consider these are the input to the Black Schoolers model to arrive at the fair value of share options at the grant date, and then to recognize that over the period, over the vesting period. I mean, possibility for, I mean, there is a model is generally accepted model which is the Black Schoolers model, which is widely used to fair value the share options. And then is there a subjectivity? Very less. Is there a complexity? No. Is there, could there be a possibility for management bias? No. Right? And whether this will result in estimation uncertainty, unlikely. So as a result, if you take, that's why I have given two examples. Share based payment, generally you would assess the inherent risk. Now if you take here, it will be somewhere here lower or close to, I mean, little higher than lower. But if you take the next one, impairment of assets, you use an entity specific model, and then the assumptions and data cannot be observed with market data. And the revenue growth here 5%. So the likewise, and the discount rate. So likewise, I mean, uh, so basically, you would basically consider the model, which is entity specific model, and then the complexity, subjectivity, and that would result in higher estimation uncertainty. For impairment of assets, which is again an accounting estimate, you would assess the inherent risk is somewhere here in the spectrum of inherent risk, which means more extensive risk assessment and further audit procedures, whereas share based payment, less extensive risk assessment and further audit procedures. So you will appreciate that not all accounting estimate would result in higher inherent risk, right? Explain why accounting estimates are considered to be a source of high risk audit risk. So this is basically the answer. I am not expecting this sort of a detailed answer in the exam, because you have to type, you have to understand this, and summarize it, and then just to explain the core concept of this answer, right? Then define following inherent risk factors. So the examples are, the definitions are in the presentation. Accounting estimate, including fair value accounting estimates, are considered to be a key consideration in an audit. Why? There could be estimation uncertainty by accounting estimates cannot be, certain financial statement cannot be measured precisely but can only be estimated. And accounting estimate always would result in estimation uncertainty could be subject to other inherent risk factors. And hence, accounting estimate, including fair value accounting estimate, always result in a higher level of risk of material misstatement. That means higher level of inherent risk. Discuss whether this statement true or false by reference to appropriate examples. Now, what is your answer? It is true or false. Can you all just, we have about 10. Can you all just send whether that statement is true or false? What is it says? All accounting estimate would result in a higher level of inherent risk, which means would result in a risk of material misstatement. That means even the useful life of depreciation, provision for inventory, all that would result in a risk of material misstatement, full of risk of material misstatement. If you take a balance sheet, there are how many accounting estimates are there, how many fair value accounting estimates are there. The account set which we checked, it will have inventory provisions, goodwill assessment, then share based payment, you know debtors provision, depreciation, useful life of property, plant and equipment, all that. Now my question is whether that is going to be whether it is true or false. Can somebody basically answer whether that statement is true or false?
True.
Sorry,
Statement is true.
true or false? I couldn't hear properly. What is your answer? The question is this: accounting estimate, including fair value accounting investors, are considered to be a key consideration in an audit. Hence, accounting estimate, including fair value accounting estimates, always result in a higher level of risk of material misstatement. Always result in a higher level of risk of material misstatement. So, discuss whether the statement is true or false. That's basically the question.
False.
It's false actually. I mean, if you refer to the presentation, now let's say we identified certain accounting estimate, no, inherent risk is low. See, estimate with low estimation uncertainty, that means higher, lower inherent risk. Estimate with high estimation uncertainty. So you have to keep in mind not all accounting estimates and fair value accounting estimate would result in a higher risk of material misstatement, right? Some will result in higher in risk of material misstatement based on the inherent risk factors and to the degree to which inherent risk factors affect the likelihood and magnitude of potential misstatement. Then you would decide whether, but not all accounting estimate would result in a higher risk of material misstatement. Then state three approaches an auditor could follow as part of performing the further audit procedures in response to risk. Now, what are the three approaches? First, obtaining audit evidence from events occurring up to the date of the auditor's report. Testing how management made the accounting estimate. Basically, we are auditing management point estimate. The method, data, and assumption, MAT, right? And including test the operating effectiveness of the control, so how management made the accounting estimate. Third one, developing auditor's point estimate or range and comparing it with the management point estimate, right? Next one, State the factors an auditor should consider in testing how the management made the accounting estimate. Now, method, assumptions, and data, all three you will not be asked, right? These things. Now, this is method, right? This is assumptions. This is data. All three, I mean, you will not get a questions. It will only be focused on one. So probably you can look at the method, right? Look at the methods. What is the question? If I change it a bit, right? State the factors the auditor should consider in testing how the management made the accounting estimate under method. Under method. So method, what do you have? Whether the method selected is appropriate in the context of the applicable financial reporting framework, and if applicable, changes from the method used in prior period are appropriate. That means whether it is consistently applied. Whether judgments made in selecting the method give rise to indicators of possible management bias. Whether the calculations are applied in accordance with the method and are mathematically accurate. I mean, if you write one or two, I mean, about 2 to 3, that would, I mean, you will get the full marks. So that is what effectively I have to cover under accounting estimate. I am not going to cover ISA 550 related party, but what I am going to do is I am going to basically, sorry, right? You can just refer to this. These are the possible questions. One of these two will get to the exam. You can read the presentation, and then the presentation has all these answers. That's all basically as far as the ISA 550 is concerned. So ISA 540 we discuss in detail, and then ISA 220, the other standard. And last week we discussed ISA 570 going concern, which is very very important. That will carry about at least 12 marks, right? So I will cover about 30 marks from the exam. Effectively, I have basically given potential questions. You need to basically, uh, practice those, and then, but only thing is you need to have clear understanding of the, what do you call, uh, uh, the this thing. So before I conclude, so this is today is my last day for the lectures. So are there any questions you want to clarify? If not, I would basically put a chat message to everyone. Uh, how do you change it to everyone in the meeting? Yes, my mobile number is note 7700 650 and 72. Basically, if you have any questions when you basically study, you can basically give me a call. If I don't answer, please basically send a chat message and state that you are from the accountancy department, you want to clarify something. I will return the call, right? So that's basically when do you all have the exam? Cover the exam thing. Exam calendar ka dalat
No,
thing. Huh?
not sir. Not yet. Not yet, sir.
Not yet scheduled, right? Okay. So you will have the study leave. Are you on already on the study leave? Or you are
Sir,
having
they
lectures
informed
during
this
this
is the
period?
study leave for.
Sorry?
Yes, sir. This is the study. They announced this 2 weeks are study leave, but some lectures are
Okay. What we couldn't cover during because of this strike. No, this strike over. Still continuing,
no,
or was it
yeah,
over?
no, not yet, sir. Still continuing the.
Okay. So, are there any questions? So I'll give 1 minute. If there are any questions, you can either ask. or send a chat message. If there are no questions, so we will basically end the session. Uh, so if you have any questions, so I have given my mobile number. You can call me when you start studying. But it's very, very important for you to attempt the potential questions I have given, and have a overall understanding. So the key standard which carry higher marks, ISA 240, which is the fraud standard, 570, and ISA 540, right? The documentation standard, I mean, about 2 3 marks, and then the related party also one of those 2 questions. And then ISA 220 also will carry, because that is the first time we are giving. So I will send the questions to Dr. Achwat from my side. Uh, so that's all I have. If there are no anything, so thank you very much for your time. So I wish you all the very best for your exam and your future as well. So if you all are taking up the advanced audit subject, we would be meeting again. If not, I wish you all the very best in your future endeavors. Thank you very much.